institutional order flow. Easiest, right to the chase, no bones about it. Easiest thing is if we're bullish, we want to see down close candles support price. And everything I just said, reverse it for when the markets are bearish. We have to do all of our buying below equilibrium or less while we're in a discount. That's the framework for high probability.
I'm going to show you guys how to actually use institutional order flow. As ICT said, when we're bullish, we want down close candles to act as real support. When we're bearish, we want up close candles to act as real resistance. There are specific times where we can apply this and it'll work. Other times you'll go to apply it and it won't work. So I'm going to show you guys what those times are that we want to be paying attention to. So I'm going to show you guys a textbook example of institutional order flow. Now, it doesn't always look like this because a lot of times you probably go into a chart and price forms a down close candle, pulls above it, does something like this, you enter, and then it just drops down for the lows. So there's a specific context that we can apply this in, and it's relative to the time that we're looking at the chart. That plays a huge confluence, and then also what the higher time frame is doing, what phase of price delivery price is in, because when price is in an expansion, that's going to be the best times to apply this institutional order flow, whether it's bullish or bearish. Meaning if we can find the start to a move, let's say it's likely to start down here and it's likely to go up to here, and price starts expanding from that point A to point B, that's a perfect example, and time is aligned, that we can apply this institutional order flow, because in an example like that, price will do this. It'll come up, it'll retrace back down, but it's only retracing, right, to build in a discount for smart money to long. Then it pulls up higher, okay? And then the down close candles formed in this down move right here. All institutional order flow that's bullish is price pulls back down and this becomes supported. So think of like support and resistance, but with actual logic, because smart money bought in these down close candles. They buy as price is going down. Okay, retail sells as price is going down. So this is going to engineer liquidity. That can be supported, and then it can pop up higher. So we're looking for down close candles to get supported and continue to expand to where price is already going. So if the move started down here and it's likely to go up here, we need that context, and it needs to be at a time of day where we're likely to see movement. Because if you're applying this at a dead time, let's say it's an Asia session or just maybe lunch session where prices, there's a higher probability of it doing this. This is where everyone messes up institutional order flow, because this is what you see on a 15-minute chart. And then if you go down to a lower time frame, you'll see something like this where it creates that expansion. You watch this video, so you think, okay, Dan said these down close candles should support price, and then it pulls down and it takes you out. And you're like, what the heck is this? It's not working. But it's because of the context of what price is doing in here. This is just chopping everyone up. It could be based on time. It could be a dead time during lunch where there's not a lot of volume coming in. It also could just be the fact that we just had clear one-sided delivery in both directions. So you had a large move down, a large move back up, and there's no clear draw on liquidity. So that being said, what am I trying to get at here? Well, I'm trying to say that we need price to be in an expansion move, and we need to have a bias that price is likely to head to a specific level. So let's say you have buy side liquidity resting above here. Let's say sell side was purged down here, and we have a good enough reason for price to trade up to here. So this is where sell side was purged, and we believe it's going to go to buy side for smart money to unload their long positions to the buy stops. They could sell to those buy stops up there. If we have this context, and it's a time of day where it's likely to present some movement, let's say in the morning session, okay, when price does create that down close candle and starts to expand away, that's a scenario where this right here, the down close candles formed in this move, when price pulls back to there, that can act as support and propel price higher. So when people come on here and try to teach order blocks and just say that every time price forms a down close candle and you get a clear expansion, look for that to be supported and then go higher, because that's real institutional order flow. It matters what phase of price delivery price is in on the higher time frame, because this exact thing that I'm showing you right here, where price makes the down move and expansion up, and then it returns to these down close candles right here, that won't work in this on the 15-minute time frame, because this move, right, you would look for this to get supported, but it's just going to go down and break that low because the higher time frame is in chop. Now, what does this mean? It means that price, let's say that this is a 15-minute chart right here, okay? If this is a 15-minute chart and it looks like this, these 1-minute expansions, it's just an expansion up. Like, it's not offering one-sided delivery where it's just doing this. So there's a context and you have to wait for it. So it's not just going to a chart and institutional order flow bullish or bearish. Sometimes it's just this, where it's just chopping around. And it's doing that for the purpose of building new liquidity into the marketplace, and or, right, it could be a dead time like we talked about, it could be lunchtime. It could have just had two big moves, so there's no clear draw on liquidity anymore. We need the context that price is likely to expand from one point to the next. Then we can use this inside of that price structure. Once we have that, this down close candle becomes high probability. Now, ICT talks about, let's say this is the high of the dealing range, okay, and this is the low of the dealing range down here. When price goes above 50% of that, it becomes a little bit lower probability in the upper 50%. It doesn't mean you can't apply order blocks there. It just means that there's a chance that if you do buy a down close candle, it runs back on you and then goes higher. So he recommends that we do our buying, if we're in bullish institutional order flow, we do our buying in the discount percent of that range. You can still look for it above here, but it's just safer if we look for setups down here. ICT considers that higher probability. So look at a higher time frame chart and see if there was a clear purge on liquidity and if it's likely to head to a clear buy side level. If it's looking like this, do not apply institutional order flow, because those short-term expansions, by the time you see that expansion and think that, all right, price is going to start doing the institutional order flow where every down close candle gets supported, by the time you see that after that first expansion, it's already running back on your stop, because it's not offering prolonged one-sided delivery in one direction. It's just doing short-term expansions, changing the state of delivery, down. Short-term expansion, you might buy this, running back on your stop. So we do not want to apply institutional order flow in a consolidation. We want to apply institutional order flow in an expansion. Now I'm going to show you guys what this looks like on a real chart, but before we do that, I want to explain something else real quick, because some of you say, okay, well, what do I do when price is in this consolidation? This is where everyone messes it up, because they don't know when it's likely to leave the consolidation, and they just want to apply what they know into every market condition. Usually it's out of fear, because you don't really know the next step to do. But if you have these rules and procedures to go about when price is in these different phases of price delivery, like in this example, let's say that this is a 15-minute chart. Okay, what do you do? Because if you're just sitting there without any idea of what to do next, as soon as you see some slight expansion, you're going to think, okay, let's start applying institutional order flow, right? Or let's start applying institutional order flow. It's bearish, where every up close candle can be respected. What we want to do is we want to look at the 4-hour or daily time frames. And generally, if we're looking at a 15-minute chart, the direction of that 4-hour or daily bias is the direction that price will leave this consolidation. So let's say that the 4-hour bias is up here. Usually when price is in that consolidation, most often that 15-minute will leave that consolidation higher. So it'll leave that range. Okay. Then we could start looking for institutional order flow up here if it's likely to continue higher. So there's only one thing that price can do from a consolidation. It always does consolidation expansion. Think of consolidation as the reset, okay? All the moves start from a consolidation. From that consolidation, it's going to go expansion. And then from this expansion, it could do two things. It could do retracement expansion, or it could do reversal. So only two things: consolidation, expansion. From that expansion, it can retrace and then expand, or reverse. Okay, Dan, so what do I do with this? Why are you telling me this? Because now you know, okay, when there's a consolidation, I'm waiting for an expansion. And then from that expansion, how I can apply institutional order flow is relative to if price is going to reverse or retrace and keep going. So like we talked about, whatever the direction of that 4-hour or daily bias is, that's the direction price will leave that consolidation most often. So if it's doing consolidation expansion and it's going up to that 4-hour bias target, well, it's not likely to do consolidation expansion and then a reversal. That's not likely to happen. It's likely to do consolidation expansion, retracement. And what does that mean? It means that we could start applying institutional order flow once price leaves this range. This now becomes a balanced price range. We do not want to see price come back into that consolidation, because it's already done the work. It already did what it needed to do in here. Now from this point on, when price leaves this range, okay, we can start applying institutional order flow. So maybe it comes back down, taps into the order block right here. Okay, this is our OB. And then you can look for a long off of that up to that 4-hour level. So that's what I look for when price is in a consolidation. I'm saying, okay, what's the direction of the 4-hour or daily bias? Because that's the direction that it's most likely to leave that consolidation. So we're not applying institutional order flow in this. We always wait for that expansion out of the consolidation. And then once it does that, what price is likely to do after that expansion? Retracement or reversal. If it's likely to do retracement expansion because the 4-hour bias is higher, well, then this is a perfect scenario where we're going to apply that institutional order flow again. Not applying it in here, waiting for that expansion, then we could start applying it again. If the 4-hour bias is not higher, what do we do in that scenario with institutional order flow? Well, we wait for an expansion. Okay, we're always waiting for an expansion out of the consolidation. So it does consolidation, expansion. And you might say, well, Dan, the 4-hour draw on liquidity is down here. Okay, that's fine. So now we're looking at this as manipulation. Okay, so this is the manipulation out of the consolidation, and then price displaces back in the range. As soon as I see this signature where it expands up out of this consolidation and pulls back to 50% of this, immediately that shows me feedback that, all right, this was supposed to be a balanced price range in here. It came right back into there. So that's a sign that this could be a manipulation, right? And if my 4-hour draw on liquidity is down here, then I could start looking for institutional order flow to be bearish, targeting that level, which means what? Up close candles get respected. I know this does look a little weird drawing it here. I'm going to show you guys real chart examples, but these up close candles formed here get respected, okay? These up close candles, price can come back and respect there and trade towards that level. So those are two scenarios from a consolidation, how you could trade institutional order flow. People teach that it's applied to every single market condition. I don't use it that way because in this, you're going to get chopped up so much if you're looking for that order block to work. It's just going to run back on your stop and then pull back higher. By the time you're looking at that expansion, it's already manipulating you and pulling back on whatever you're trying to do, because these short-term expansions also engineer liquidity. If you guys are interested in seeing more content from me, I have a Discord server where I call the market real time. I also have tons of educational videos in there. There is also a free section of the Discord that I recently added where I keep an archive of these ICT clips, ICT gems, my 2022 mentorship notes, a lot of stuff in the free Discord as well. If you guys want to join the premium, I do keep a live log. So in the free section, you could check out my track record of the ideas that I post in the premium end. So that's in the free Discord. So if you guys are interested in that, you can check out the links down below. Okay, Dan, so what does this look like on a real chart? Well, here you are, prices in the consolidation. Remember, this is what we want to avoid doing. Okay, we do not want to apply institutional order flow in this. Okay, price does an expansion down. What did I teach? It can do an expansion and then a retracement or reversal. Sometimes you don't know. So let's be realistic here. You're not just going to see an expansion and know right away, okay, this is a retracement, this is a reversal. But what did I say? This is a balanced price range now when price leaves this area. So when price expands for liquidity and then it pulls right back up, what does that show us? Immediately it shows, okay, I didn't want to see price return to this balanced price range. It's likely to be a manipulation down here, and now it can target the buy side liquidity right here. What does that mean? It means that from this point on, right in here after this expansion, we can start looking for institutional order flow to be bullish. Price shouldn't have came back into this consolidation, so it pulls up higher. It's not always that it's going to return to the order block. Think of it like it's just not offered in price at that time. So don't think, okay, every time it forms an order block, it has to come back to it. Sometimes it'll respect bullish fair value gaps. That's something you see in institutional order flow that's bullish. Okay, price pulls up higher. We have this small down close candle in here. You can see that gets respected. Okay, and then price expands away from it, right? Pulls up higher. You have this down close candle. Price pops back above it. Okay, you could also mark out the midpoint of these down close candles. They can get respected. So if you mark out the midpoint, this is called the mean threshold. It comes a little bit short in this example, but pulls up, expands away. See these two down close candles. I would extend the opening price of those down close candles. Okay, you can mark out the upper wick of it as well. It's really the entire down close candles. When it's really bullish, sometimes it just trades into the wick. You can see it touches that, expands. Okay, forms a down close candle here. I like to see fair value gaps next to the order block. Okay, because this gives feedback that it's really, well, number one, it's just institutional sponsorship, seeing that fair value gap form, and it just gives more confluence. Okay, down close candle right here, respects that, expands away, down close candle again, and this is all under the basis that we had the manipulation back there and then it displaced back into the range. So don't think that you have to know that it's going to reverse right when it starts to drop lower. Think, okay, it could be a retracement, it could be a reversal. I'm going to wait for feedback. This was our feedback, this expansion back up. It would not have came all the way back up to here, right, with that much speed and velocity if it was just doing a retracement to go back down. So we can wait for feedback. You don't always have to know. A lot of trading is waiting. So we're just waiting for it to become super clear where we cannot frame it any other way. And that's the time where we want to go in there and we want to hunt for our setup within the expansion. When it's in this, dude, do something else. You do not need to be trading here. You don't. Because eventually, inevitably, you're going to get that expansion. When does it leave that consolidation? Right at that macro, 9:50 p.m., okay? This is an Asia session. We get that 9:50 to 10:10 macro, displaces us lower, then it forms the reversal. Notice how every down close candle is getting respected as price is pulling up higher. Now I'm going to show you guys some paper trade examples in this. This is just a demo account. I'm not trying to flex or anything. This is the institutional order flow that I was applying as this move was expanding higher. So we can go down. I was using an ultra low time frame in here. Where was that at? Here it is. So the reason I'm showing this is just because these are the examples when those order blocks work. When price did the consolidation, expansion, manipulated, pulled back up, and there's clear liquidity to target. This is a clear scenario where it's likely to be in an expansion phase for longer because of the fact that there's clear liquidity higher. It did the damage lower. Now we could pull up higher. So this is just me just participating in institutional order flow in an expansion. So when price runs beneath the short-term low, you can expect that to become protected. It pops back up. Now this down close candle can get respected right here. This was the idea. Okay. This down close candle. Okay. Stop beneath 50% of this wick. It should not pull back down to there. Pulls back higher. These are just very low time frame scalps in here. Buying here. Okay. I was trying to get in near that order block right there. Pulls back higher. Exiting. This order block right here. Entering. Exiting. So I'm exiting in up close candles, trying to buy in down close candles. This one was a little bit higher, but that's the idea here. If we can frame a clear expansion from one point to the next, and there's a reason for price to actually expand, that's when we want to be applying this. Once price does the expansion, takes out all the liquidity, I'm not really interested up here because it's just going sideways. So that was institutional order flow. It's bullish. Here's institutional order flow. It's bearish. Okay, price came up, took out the buy side liquidity. Okay, we had a nice clean move down and then a clean move back up. Generally, a good rule of thumb is when you get very clear low resistance moves in both directions, just wait for a consolidation. Now you know, inevitably, out of that consolidation, we're going to see expansion. Expands down. Okay, we have all of this low resistance liquidity in here. It's kind of like trend line liquidity, which means that once price is in this little consolidation right in here, what does that mean? Once we get that expansion, I don't think it's going to go expansion reversal. I think it's going to go expansion retracement and then just keep going lower because there's a reason for price to go lower. It's already knocked out all the buy stops. And there's all these sell orders just waiting to be triggered if price goes down there because everyone thinks that this is support. Okay, people also trade breakdowns if it drops beneath those lows. So that's an area to take price. Along the way, these up close candles acts as real resistance, pulls back down lower. So those are kind of like the frameworks that I like to look at. When we're bullish, we want to see down close candles get supported. When we're bearish, we want to see up close candles act as real resistance. When we're bullish and price goes beneath the short-term low, and then it expands back up, we look for that to act as a protected low and not go back beneath it. You saw that in some of the entries I took in that expansion. But that's really the idea here. You just want to make sure you're absolutely not applying institutional order flow in these tight consolidations. It's going to do nothing but chop you up, drain your mental capital, and by the time it does expand, you've already wasted all your mental capital trying to trade it within the consolidation. The number one rule is, we'll wait for expansion out of that consolidation and just look for clear levels. Just, when it's a clear draw on liquidity, it'll stand out. Like this was super obvious. Trend line liquidity right here, comes back down, takes it out, 950 to 1010 macro, leaves that consolidation, puts in a low, and then expands back up. And this is very, very clear right? Low resistance liquidity to target. It's not always like that. Like up here, it's not like that. So you do have to wait for the moves. But if you really just wait for it to be super, super, super clear where you cannot frame it any other way and then apply institutional order flow, you're going to see it work way better in your hands instead of just trying to apply every down close candle as support, every up close candle as resistance.